Welcome back, everybody, to another episode of the Three Seasons podcast, where we talk about the three seasons of your wealth, accumulation, protection, and succession. I am very happy today that we are joined by our guest, Greg Einarsson. Greg just joined the portfolio planning team with me and the other advisors, and we're super lucky in that we were able to convince him to work with us because we wanted to have him on the team. And Greg, thank you very much for coming on. I appreciate you doing this.
Oh, thanks for having me, Tyson.
So today we wanted to kind of talk a little bit about a singular topic, the topic of estate freezes and like why somebody would do that, what it is, and what are some of the basic mechanics of that. And I guess before we jump into that, would you like to share a little bit about your background and your expertise, which is the reason we wanted you to join the team?
Yeah, I'd be more than happy to. So, my background is actually on the carrier side for insurance. So, for those that wouldn't know, what that would be is, I would work with advisors like Tyson. And what my specialty would be is actually working with the insurance product itself. So, finding what works, what makes sense for the end client to achieve their goals. And we would see if we could manufacture the best plan to suit each client's needs. So, I spent a few years at Industrial Alliance. I spent nearly 5 years at BMO Insurance, where my specialty was corporate and estate planning for high net worth individuals and finding insurance plans that matched with their goals and their desires and how to implement that with their overall financial plan. So that's where I spent, the last almost decade doing for clients. And I'm really happy that I'm with the portfolio planning team that I can bring that kind of specialty to our financial group and provide that detailed specialization and knowledge to help our clients.
Yeah. And we really appreciate it. It's nice to have a second set of eyeballs that say, hey, listen, I think as an experienced advisor, I think I'm doing it right. And then have somebody that comes in that's had a lot more experience and say, hey, listen, we need to fine tune this and we need to increase that. We need to do this. We need to add that. It's nice to have that extra piece on the team to make sure that we button up everything. And so happy to have you.
Yeah, because you know what? Like with the second set of eyeballs, it makes a lot of sense because a lot of times in any industry, you kind of know what you know. And
Yeah.
when you're looking at something, you have an idea of how to solve a problem. You've had tons of clients, you work with them, and you say, hey, okay, I've done this before, and this is what I would do. Having a second set of eyeballs always gives you that opportunity to say, hey, is that the best thing? Could there be something suited towards their needs that might be a little bit different? And there's always pros and cons to implementing a different style solution, especially on the insurance side of things when we're talking about estate freezes and how you would actually fund tax liabilities. There could be, if you talk with lawyers, accountants, financial advisors, you're going to have a lot of different solutions to solve that problem. And each one is going to come from the angle of, hey, what's their expertise? Because a lot of the things that we're going to talk about today, you don't necessarily have to use life insurance. There could be other avenues, but there hasn't been a financial plan and a goal that, specifically for an estate freeze, that a plan couldn't be, lifted up and made better by incorporating insurance inside of it for that
Right.
type of need.
Yeah, that makes sense. Um, it seems to be in some cases when it fits and when it works, it's like the most efficient use of dollars that a lot of clients can see. And rather than having a pile of cash sit on the sidelines in event of, whatever the planning objective is. And this is great. And you get to use other people's money. And inside a business, there's a few additional benefits, which I'm sure we're going to talk about. So from the 30,000-foot view, what is an estate freeze?
So an estate freeze in a really easy, a simple way to explain it, it's that you will typically have a corporation and you're going to freeze or lock in that appreciated value. And then you're going to pass on the future growth of that value to whoever is taking on those shares afterwards. So this is a really popular strategy for somebody who is going to be transferring a business to a child, or possibly to somebody else inside of their business or practice. So you want to make sure that your taxation is capped, and then everything going forward is going to be passed on to whoever inherits the business going forward. So, with that, it's a very useful tool to incorporate into your financial plan, to make sure that you're taking care of your tax liability while also finding an efficient way to transfer that asset to the beneficiary of that asset.
Yeah, that makes sense.
Yeah. So, with that, there's a lot of different ways to, think about it and do that. But before we get into any of that, a lot of times where this conversation will lead with advisors I've worked with is you're talking to them about their estate plan. Before anything is implemented, there has to be a thought about, hey, what am I going to be doing with my business, with my personal finances, with my corporate finances? And that's really where this all stems from. So, to be totally fair, I typically see estate freezes that I've helped advisors work on in older ages that are closer to retirement. So that's really a strategy, that and timeline, that's kind of where we see it, because people are already thinking about, how am I going to transition out of this business? So they have a very good idea of where their business is, how much that they're going to need in retirement, because that is a big key to be thinking about when you're going to be implementing something like an estate freeze.
Yeah.
So you want to make sure that you have enough assets to live the lifestyle you want to going forward. So a lot of these things stem from, hey, a simple conversation about, what does my ideal retirement look like? How long do I want to work for? Do I have somebody inside of my business that's going to be taking care of this going forward and grow it? Because there has to be a real need to grow the business. It's not, if you're going to cap your capital gains liability at, $2 million, but there's no growth potential for the business, is it really an optimal strategy for you? It may not be.
Right.
So there still has to be growth inside of your business, and growth that the other successor taking on the business is going to be able to take that and grow it further.
Right.
Yeah.
That makes sense. Um, so who do you see generally as the appropriate type of client where a strategy like this is successful? What's their dynamic like?
Usually what I would see is it would be a family business. A lot of times
Yeah.
do this. And there's a clear succession plan. So that's really been outlined. And then what they're going to do is they're going to implement an estate freeze, say as a couple. A lot of times it's going to be a husband and wife running that business. And I want to leave it to one of my children who's already working in the business and is going to able to continue to grow this. I'm nearing retirement, and my plan is to either semi-exit the business or retire completely. And then I want to make sure that I can utilize an estate freeze to cap my capital gains liability and maximize my lifetime capital gains exemption. So it's really about tax efficiency on the estate planning side. Because what estate freeze is going to do for you is you're going to take your common shares, exchange them for preferred shares in your organization, and then you're going to be able to take those frozen shares, so what you have an idea of what your tax liability will be. It's always good. This is always going to be done with, another professional involved, and a tax professional.
Yes.
So that they're going to talk to you about what your strategy is. Because for each person, it's going to be different depending on the type of organization or type of business you're in. And hey, am I going to be able to utilize my lifetime capital gains exemption? And hopefully, that person inheriting the business also has the opportunity to use theirs as well, so that you're really benefiting from both of those. So that's really, an easy and the most commonly used one that I see is that families that are continuing to be in business, the business is going to continue to grow, and that you have a clear succession plan going forward. That's typically who I'd see this type of strategy be used for.
That makes a lot of sense. I've seen a couple of examples of families that have a very successful business. They don't understand though that there's capital gains involved on like from them starting the business at ground zero to where they leave it off at generation two. Are you able to maybe talk or articulate what that would mean for somebody who's run a business but doesn't understand that they've already paid income tax, they've paid their small business tax, they paid all those things, and now you're saying there's more tax when I want to exit. What does that actually like look like?
So it's a grim reality of a business. It's that you've been ultra successful, and when you're looking to transition the business, you're going to have a huge liability. And to even take a step back from that, it's a lot of times this planning is done at a later date. You're already exiting, and now I'm trying to put a plan in place to make sure that this is going to happen. Because a lot of times, if you don't plan and you have a spouse, how this is going to function is that okay, if somebody passes away, those shares are going to roll over, and now your husband or wife is going to be sole owner of the business. And that's a reality. Now they have to put together a plan to try and either sell the shares, but with an estate freeze, you're typically going to have somebody as a successor take over those shares. And a lot of times that's going to be somebody internally from the family or internally from your practice or business.
Yeah.
So when you're thinking about that type of planning, and you're going to have a huge tax liability, and it's just the unfortunate reality of being successful that CRA is going to come in and look to get their piece of the pie.
Yeah, yeah.
There's going to be ways that you can mitigate that, and the huge one is going to be the lifetime capital gains exemption. There are rules associated with being able to claim that as well. So when you think about even planning, and a lot of times people will look at that type of planning when they're actually looking to make a sale, but you want to make sure that you're even eligible to claim that deduction, because
Yeah.
that's going to be an enormous deduction. It's off the top of my head, I think it's 1.1 million
You
roughly
think
right
so?
now.
Yeah, I think so too.
So yeah, so to be able to take care of $1.1 million in capital gains, that's going to include a lot of business. You want to be able to maximize it. And that's why state freezes are such a commonly used strategy. Because if you're in that, area of I've grown from nothing and my corporate valuation might be 2.2 million. Now I can fully maximize my lifetime capital gains exemption, not pay tax on the sale of my business, and then future growth is going to be inherited, and future growth and future tax liability as well is
That's
going to
right.
be inherited by my successor. And they could hopefully utilize their lifetime capital gains exemption as well. But what the big thing is there is that, before we even look at, an estate freeze, it's that will my business qualify for the lifetime capital gains exemption? And that's going to be your first question when you're
Right.
doing this type of planning. And is that person who is inheriting it also going to be able to utilize that as well? So that's why an estate freeze sometimes can be thought of as complex, because depending on the type of business you're in and what you've done inside of your business, are you going to be eligible for that? And a lot of times that's where this type of planning and organizational structure is the first step. First step I would say is have a plan.
Yeah.
You gotta make a plan, right? And that's where this all stems from. But am I going to sell? Am I going to sell internally? Is this going to be passed down to some of my children? is there somebody to run my business? Do they want to be a part of it? And that's where, I mean, we have the conversations like this all the time. Do I have children that want to run my business? And if you do have those and children that are part of your business, this could be a great strategy for you.
Yep.
But I always like to ask it, who wants the proceeds of the business and who wants to actually run the business. I think of farming all the time. Who
Yeah.
wants to do day to day on the farm and who wants the farm to sell the farm. Not many people want to run the day to day operations of a business, but they want all the proceeds.
That's right. That's right.
So first step, have a succession plan, and that's for retirees or near retirees in their business. That's a lot of the conversations that we're going to have. Hey, how do you want to plan your estate and succession plan on the corporate side? How do you want to do that on the personal side as well? And we can implement plans and strategies with other professionals to make sure you do that in a really tax efficient way.
Yeah.
Because one of those things that we talk about, even being eligible for lifetime capital gains exemption is, what are the assets inside of your corporation looking like? Because that could implement, and organizational structure. Because, depending on what that looks like, you might need to kind of set this up differently. And you don't need to go into the details, but you want to make sure that it's set up in a proper way. You might even need to, if you have just an opco, you might need to implement a holdco.
Yeah.
Do you have a family trust? How is this ownership of the preferred or the common shares? What's it going to look like?
Yeah.
And making sure you're set up well before you actually do these things. That's why we always work with our tax professionals to make sure that that's implemented before any kind of solution is put forward. Hey, make sure your planning and your process is done correctly so that you can utilize these benefits to maximize your tax efficiency when you're actually going through your succession plan. Because without proper structure, the solution isn't going to create a positive reality unless every step is done correctly.
Yeah.
So that's from the big part is planning properly, and then based on that plan, putting a proper solution like an estate freeze in place to minimize tax, because the CRA they're going to be eligible to take tax, but there's no point in leaving a tip when you can create a solution to minimize that and maximize what you're going to get back tax free. That's really what we're here to do and to help with.
Fantastic. Yeah, that's exactly right. And we harp on this a lot as a team, but incorporating your entire financial team, so your legal, your accounting, your financial professionals, if you have a different insurance or investment professional, is we want them all on the same sheet of music so that from a client point of view, it goes off without a hitch and you're able to transition because there's enough problems within a family business or a small business without having legal or accounting problems because somebody wanted to do it a different way. Um, what a nightmare that would be.
Yeah, these things are complex to begin with. Unwinding one is difficult. So you want to make sure that you're eligible and that you don't need to do anything like that. And that's why something like retirement income, that's a piece of the pie as well. If you freeze the shares of your company, do you have enough value outside of that, or with that kind of freeze going on of your value, do you have enough to comfortably retire for your plan?
Yeah.
So that's going to be an important element of it as well. If you're going to freeze likely your largest asset and freeze the growth on it for you, you have to make sure that proper planning is in place. So that's why, when you implement a strategy like this, it's not just what's on the corporate side, it's also what's on the personal side.
Yeah.
And,
Absolutely.
being able to move different assets around And, when we talk about that you want to make sure that you're also not incurring taxation on those types of transfers. So when we think about, an easy structure of I just own an opco, well, do you have to open up a hold co? Do you have investment assets? Do you have passive investment income going on inside of your business that you may need to move to a hold co to make sure that you're going to be able to collect your lifetime capital gains exemption,
Yeah,
you know, and that all comes from structure. So there's a lot of things that you may need to put in place to properly implement the solution that best fits your needs. Because honestly, like a lot of times, like no one's preemptively planning. You are only planning for succession and corporate structure a lot of times around a initial need.
yeah,
So when you're thinking about, hey, I may own just my company and I just like to transition it, you know, seems fair.
yep.
that's
That's right.
that's what you do day to day. You're you know enveloped in your business, right? That's your life. Now transitioning it, you may need to take a bunch of steps to make sure that you can actually maximize the benefit to you in building that business. And that's where the estate freeze, comes as a part of your plan. Because before that can be implemented, you may need to open up a family trust. You may need to open up a hold co, and then you may need an estate freeze.
Yeah,
And so you got to make sure that before that freeze is put in place, that your organization is properly structured to benefit who you want it to benefit and not benefit the CRA.
100%. That makes sense. So part of the logistics of everything that you just talked about, I know when we have our accounting team on, they talk about purifying the corporation. And I think that's a nice label for it, but that is exactly what you were just talking about, stripping out the unnecessary parts that's going to throw your ratios offside. It's going to make it uneligible for that lifetime capital gains exemption. And you want to have your ducks in a row. And so having a CPA team that can work with a planner and see all these steps, it makes so much difference versus either a DIY accounting system, which, I mean, 80% of the small businesses in Canada are family businesses. And so I bet you a lot of them do their own bookkeeping, do their own accounting, and you just don't know, they don't know what they don't know, right?
Exactly. You really need to take on these professionals that see this day to day, that can implement a proper strategy for you. Because the professionals we refer our clients to, walk them through it, right? Because they're there to talk about a strategy that may not be able to even be implemented for 6 months down the road.
Yeah,
You need to make sure that it's structured correctly. So, the driver to those professionals is a need, but you need to make sure that it's properly structured. They see it day to day. They're able to put a plan in place so that you can maximize your benefits of your corporation. So those are going to be expenses, but those expenses are going to be very minimal to the amount of benefit that they could actually give you.
right.
So it is an out of pocket cost, but if it's going to save you $1 million in capital gains, that's $1 million you and your family can have versus the CRA.
Exactly.
And and you'd be silly not to take advantage of that and put a proper structure and plan in place to find the right succession plan that's going to benefit yourself and your family throughout your retirement, and going to be able to benefit the business going forward. Because a lot of times, if none of this planning, I know we're talking about planning, but the reality is that if you don't have a good succession plan, what is that going to look like? And a lot of times, what that's going to look like is not very good.
Yeah,
It's going to be a sale either by a spouse or inside of your estate, and what's that going to look like? And how are you going to be able to, maybe if it's in your state, how are you going to be able to sell it? How is somebody going to be able to access it? How is somebody able to be able to know what its real value is
Yeah.
if they're not a part of the business?
Yes.
And, at that point, you're really going to be getting a fraction of the value of the business that you help build. And the CRA is going to take a lot of that money at that point, and it's going to benefit the government, and it's not going to benefit your heirs and who you actually want it to benefit. So
Yeah.
proper planning is really just a step to make sure that benefit and what you've built throughout your entire life is going to who deserves it and not to the CRA.
Yeah, exactly. No, that's very well said. Um, it's tough to have some of these that especially to unpack and open this conversation with some business owners because especially for like men who are at 55 to 65 years old, if they're really good at their profession, a lot of times they identify as their profession. And so to have conversations of them not being them anymore, it's tough to kind of start that conversation. But on the flip side of that is I've worked with some business owners before, and they have done very, very well. They've built themselves from nothing, and they've got a business, and it's going really good. And then you ask them what their retirement plan is, and they say, "Well, I'm just going to sell my business. I'll just cash out." And not understanding that there's alternatives. Maybe the kids are adults now. They want to run the business because they grew up in it, or they want an opportunity to buy the business. And so these are some of the scenarios that we come across. And estate freeze is one possible scenario for us, carrying that tradition on, as well as having the, generation one that stood it up, be able to retire comfortably and still see their legacy.
Yeah, exactly. Right. And this is just, a great conversation about overall planning because depending on what you need, this might not make sense for a majority of business owners who are planning to sell. Because why freeze your shares? Why freeze the capital gains liability if you're going to sell?
Yeah.
So it's really about what the client goals are because this may not be a strategy for somebody who is going to sell in retirement. But when we talk about that, there's lots of we deal with lots of medical professionals, and that type of sale of a practice, that also comes with complex tax issues. So you're not just because you're going to sell the practice doesn't mean you're not these realities aren't going to arise.
Yeah.
They're going to arise in a different way, and they're going to be while you're living, right? And when we're thinking about an estate freeze, that's when you're going to pass away. You're going to freeze those shares. You're going to know your taxation liability. That's still going to roll over depending on how you structure it. It could roll over your spouse still. But what the plan allows you to do is that if you are having somebody succeed your business, then you're putting a plan in place to do that in a tax efficient way. You're able to use the government benefits to maximize you during your retirement. You're giving the best advantage to that person inheriting that business going forward. And you can take care of the capital gains liability that is associated with those shares. And why that's really important is that, no matter what, if we're going to do a share sale, you're going to try and maximize your lifetime capital gains exemption. That may or may not, take care of your entire taxation liability. So there's going to be strategies on that end. But if we're doing an estate freeze, what you have the opportunity to do is actually pre-fund that taxation liability. And that's why we work with so many tax professionals, because when they identify somebody doing an estate freeze, they are taking into account, hey, do I need to purify my business? Has it been purified? Am I able to claim my entire lifetime capital gains exemption?
Yeah.
And now, on top of that, maybe I ran a very successful business and my taxation is actually going to be above that $1.1 million threshold. how am I going to fund that with somebody inheriting my business? Do I have the assets inside of that? And if I do have the assets inside of it, am I qualifying for my lifetime capital gains exemption?
Right.
It's like a push pull, right? Like it's like I have all these investment assets. Maybe my business doesn't like fully qualify, and your tax professional is going to be able to tell you the steps to take in place to actually do that. But
Yeah,
if if you have a lot of passive investment assets, maybe I need to open up a holdco. They'll probably suggest that anyways.
that's
And
right.
then how am I going to fund the remainder of my taxation? Well, if I'm not taking it from the business, how am I going to be able to do this? And life insurance is a very easy and simple way to do if you're healthy,
Yes.
right? And that's why the planning is great to put in place while you're younger. That's going to give you the best opportunity to purchase life insurance with your health in the peak that you can, because you're always going to be healthy. Well, not always, but you're typically going to be healthier today than you are tomorrow.
Yep.
And your health is what's going to buy you life insurance. And when you're thinking about, the assets inside your business, that's a great way to fund it. And you're able to figure out what your tax liability is roughly going to be, and your share valuation. You're able to freeze that. And then, we come in with an insurance solution to fit that need. And then you can comfortably say, hey, I pre-funded it. I'm taking care of my remaining capital gains and taxation and estate liability. And I've done this in a very seamless way where now my ducks are in a row. I'm completely prepared. The person taking over the business now has ample room to grow the business, not worry about the taxation going forward. I want to grow the business as far as I can. I want to utilize my lifetime capital gains exemption, and
Yes.
I want to really rinse and repeat what the generation before did and continue that lifelong success of the business. And, that's what an estate freeze really allows you to do. It allows you to create a relatively fixed need with your tax professional about how much liability you have, being able to find a funding solution for it,
Yeah.
and then allowing that business continued growth and success going forward. And that's really what it's about.
Yeah. That makes a lot of sense. That's a great wrapper on that. Um, so when we're working with somebody who's 50, 60, 65 years old and they want to put an estate plan or estate freeze in place, and then we start doing the planning, sometimes what happens is they see the funding mechanism, which would be life insurance, and they get sticker shock because they're on the older end of the spectrum. Are are there processes in place where maybe they can have a solution, but not cost them a lot of money?
Yeah, they do. And I'll kind of break it up into two parts, because roughly this is the product solution is going to be typically based roughly on age. The next thing it's going to be based on is investment returns. So how much risk they want to take.
Yeah.
But, typically what we're going to find is that as a couple, if you're below, say, 60, a lot of times it's going to be a whole life solution. And that's a good product because with a couple at roughly 60 and below, they're going to have ample time to be able to have that death benefit grow and be able to take care of their capital gains liability. And then everything above that is really just an addition to their return. And so, what a lot of times we'll look at is that we'll have a whole life policy for growth, and maybe underneath we'll have layers of term so that they're never completely uncovered for their full taxation liability if anything were to happen, if they already have the estate freeze in place. I want to make sure that that's fully funded. And then in time, that term will be able to be removed when your whole life benefit has grown to be able to take care of your need. And then the remainder of that growth is really a benefit to your, entire estate. When you're maybe above 65 as a couple, above 60 as a couple, a lot of times what I'll see and what I've put in place is actually a universal life strategy. And I know in the industry, there's going to be a lot of people saying, this guy is crazy. Universal life is um, permanent life insurance policy that has investment components. So you're able to choose from a range of mutual funds, segregated funds, GICs, and other investment options that a company would have available under their banner. And that selection and choice is great. But a lot of times what happens is that choice is, what's illustrated and what is, an assumed rate of return. And that assumption and predicting the market, with long-term growth can sometimes be very volatile. It's just like the market. Like if you were in the S&P over 40 years, you're going to be, pretty steady as far as growth.
Yep.
But there's going to be peaks and valleys. And you don't want something to happen when you're in a valley and it doesn't totally fund what you need it to do. So putting the proper structure in place in these product solutions is key, especially when you're using universal life, because you don't want something to happen where I didn't get the investment return this year or over a 5-10 year time span that I anticipated. And now this solution doesn't fit my needs.
Yeah.
So what I do to safeguard that is I use a universal life solution. And a lot of times what we're going to do is we're going to do face amount only. And that leaves you no room for growth. But for somebody looking at an estate freeze, you don't necessarily need growth. You need to be able to cover a fixed need. So we'll use a husband and wife example. And we're going to say they're both 65 years old.
Yeah.
And they need $2 million worth of coverage. At that kind of age, typically universal life is going to be a cheaper dollar for dollar amount versus whole life. And what we would then do is use the cost of insurance. And a lot of times when people are looking at estate freezes, they have the assets available to pay for the policy. I know it might be sticker shock,
Yeah.
but just like investing and just like with anything, if you pay earlier and allow time for that money to grow, it's going to grow and then be able to compound for you and be able to generate the biggest return. So for somebody who has the cash available, we can take a universal life policy, pay it down in a very small window of time, say, 5 years.
Yeah.
And then use a GIC to back it. So we're going to take a rate of return, usually it'll be in a 10 or 20 year GIC duration. Could even be, some carriers even offer 30 years on a duration. And that's really good because if you're 65 and depending on the type of universal life policy you buy, that might take care of your entire time duration inside of that investment. So what you can do is you pay for your life insurance policy, it gets invested in GIC, so you don't have to worry about the volatility inside of getting rates of return. That amount of money over that duration is going to pay for your entire policy. When it's paid up and you can see that it's going to be able to fund the policy for the remainder of time, you set and forget it. You can leave it in your drawer, and that's what's going to pay for your estate need or your capital gains liability inside your business.
Okay.
And that's the kind of two solutions on the product side that we're typically going to look at. Um, and that's going to be the simplest way because when you get older, universal life becomes cheaper for a fixed need, and where whole life becomes expensive, and you might not be able to get that growth inside of your policy that's needed and required to pay for your full capital gains liability inside of your corporation.
Right. Okay. That's a great way to put it. It's funny that um, as we talk about sticker shock and what happens with people, there's the other side of the coin too, where we have business owners that they have the cash flow. It's not a big deal for them. And the more cash flow that they have, maybe they have to commit less to the product. And there's even a solution out there where you overpay for your insurance up front, but you borrow all the money back, and then you get to use it within your business, and you still have a solution. So it's like two birds with one stone.
Yeah, you can like do that. That's also a great need. Like that's a great thing that typically whole life can do for you. You're able to lend against that value. So that's another reason why whole life for somebody who might be a little bit younger is a great solution because you're not stuck in, you're not set in stone as much as with a universal life plan. The universal life plan that I described, it's pretty rigid. You
Yep.
can't you can't do too much with it because the value is going to be used to pay for your entire cost of insurance during your lifetime. So if you start making changes, you're starting to add more risk inside of the solution than it can probably handle. And you'll probably need to either put more into it or, take more risk.
Yeah.
And so it really depends on what you need, right? And that's why, when we talked earlier about, hey, how much do I need for my retirement? It's great to think about because these solutions can all also be used as alternative asset classes that you can leverage in the future. And to be totally fair too, you might not only need one policy, right?
Yeah.
Like you can have a policy in place for a specific need, and maybe you'd like another policy in place to take care of another need, right? And insurance is a great product to also take care of longevity risk, right? Because a lot of people have plans and, I don't know when I'm going to pass away.
Yeah.
It's a, it's rather arbitrary. We have a general idea,
Yeah.
um, but you never know. And that's what it can also be used for. Because at the end of the day, if I live to 90 or 95, I may not have the retirement assets. Well, I didn't plan on living that long. I didn't have the retirement assets available to pay for me, take care of my lifestyle long term. And you might be getting OAS, CPP. Is that going to be enough to take care of your lifestyle? Each person is going to be different,
Yeah.
but likelihood, it probably won't.
Right.
Now, if you have an additional asset like life insurance and specifically whole life insurance, maybe like, if you've lived that long, that's probably grown to be quite a substantial policy. And that could also be used to supplement your retirement. You could take that and get a loan at a bank or Manulife Bank, Equitable Bank. There's going to be lots of suitors depending on when that is
Yeah.
down the road. Hopefully there's more down the road.
Yeah.
But that can also help with, longevity risk. And that's a key thing that, we like to talk about with our clients as well. It's that how do you protect yourself from living too long? This can be an additional asset that can be utilized for more than one purpose. Insurance isn't always just for benefit long term. You can utilize it while you're living. There's lots of great benefits, and we're just talking about one.
Yeah.
But that can be a great asset to have and to hold, to be able to use if you have longevity risk and you live too long. A lot of people don't know about that type of benefit or have been educated in how to utilize it, but that is another great benefit that life insurance holds, and everyone can really benefit from that long term if you have a permanent solution in place and it's funded correctly.
Yeah, right. That makes sense. Um, I think what's interesting is, been hearing about this strategy, right, of an estate freeze for years. There's a lot of people that have done it. And then in the last couple of years, I've actually come across families where they had a bunch of real estate as part of their business. And so when you did their estate freeze in the early 2000s, well, between 2000 and 2024, real estate prices in Vancouver have skyrocketed. And so they had to do a refreeze because the amount of like growth and stuff that was in the business and the tax liability that was going to be passed on was enormous compared to what it was. I don't know when they did it first. I think it was 2008 or 2009, and dramatically different view from their standpoint.
Yeah, no, it's the reality, right? Of anything, right? You put a plan in place, and you might need to make modifications to that plan.
Yeah,
But when you're planning an estate freeze, it's great to bring up those types of points on those types of assets with your accountant as well, so that you can put steps in place if you do say need to make modifications. It might sometimes be called a melt.
yeah,
Um, and then you're going to be able to make some changes to make sure that your plan is in place to be most beneficial, because we really don't know, right?
yeah,
In these kind of growth assumptions, a lot of times we'll say real estate, it may be 8, 10, 12%, depending on the location. You could get huge returns if it's in locations that are going to be developed in the future, rezoning
yeah,
properties. um, it's something that's going on all over, especially BC. Many properties are being rezoned, and what was once, say, a large residential property could be worth 30 million,
yeah,
50 million, depending on where it is, if it's in an area that can be developed. And you might need to take steps to modify your plan. But I mean, at the end of the day, a lot of times it's a good problem to have if your assets are performing well.
yeah,
Um, you really have the at that point you have the ability to make changes to your plan and be able to pay for them, because at the end of the day, these strategies are still going to be immensely beneficial
yes,
to your overall plan and how you're going to do it. If you need to make a modification, that's no problem. It's better to do that than to have no plan, because it's a great problem to have if you have to come back and say, I need to make a change. I have too much wealth.
yeah, yeah.
That's
More money, more problems.
exactly. And so it's really, they're not set in stone. These types of plans, they always change. And you may not, depending on the assets that you have, you may or may not need to make a change to your estate freeze. It
Yeah,
really just depends. And if it's overperforming stocks, if it's overperforming assets that you're holding, you know, you probably put them in the right place if you already have an estate freeze, and then you could move them around. You could, melt the estate. You might want to, incorporate other things. Say if it's family planning. I have
yep,
more dependents. Maybe I have a plan to add somebody else in. I have a second family. Those things happen, and you might just need to incorporate more structure into your plan
yeah,
to make sure that it's optimal for what you're doing going forward. But that's key too, right? I mean, we talk about it all the time. Reviewing your plan, making sure that it's in order, because reviews are essential in any planning, right? Because the plan is dedicated to that date that plan was,
yep.
and life changes.
That's right. Yeah, that time, that moment in time where we frame that, um,
Yeah,
that's gone, and it's our platform that we build off of. But yeah, you may have rocketed to success since then, and we need to dramatically bolt on some solutions.
Exactly, right? And depending on what you're doing, you might want more, like, you might need more insurance. You might need to be donating different types of investment funds. You might want to give more to charity.
Yeah,
Depending on what you need, it's always important to meet with your financial planner to discuss those material changes
yeah,
because if depending on what stage of your plan is, you may need modifications annually, right?
absolutely.
Because things like your income's changing, your cost of living's changing. You may have started a family. You may have more investment properties. That plan was in place to take care of the needs with at that time,
Yes.
and there's nothing stands still,
Yeah, you could have a
right?
third generation enter the picture by that time, right? Kids get married and have
Exactly.
kids.
You may have bought another business, right? We see it all the time with physicians buying additional practices.
Yes.
They grow their practice. That is excellent,
Yeah.
but at the same time, you've grown your liability.
Yes.
Are you properly protected on the business side of things, personally, disability? What happens if you get sick?
Hmm.
All those things come into play. And that's why it's important to always be reviewing. And when any sort of material change happens, or you're expecting it, or if you just like to change your plan, if you want to retire early, those are all going to be things that are going to be variables that change in your assumption. And then you're going to be able to diagnose what's most important to you,
Yeah.
and then we're going to be able to help provide a solution to meet your goals, because no one's goals stay the same. you
Yeah.
know we look five we talked to a client 5 years ago, talked to them today, it's going to look nothing like the plan that they had 5 years ago, but there's going to be solutions and things that they can implement to make their situation better, no matter what.
Yeah.
So it's always, reviews are key, and it's a key part of you know them growing their business, and us making sure that they're properly protected and growing, each step of the way.
Yeah, totally. I agree. You sparked a couple of thoughts as you were going through that last little bit. There's a scenario where we've been adding to our financial planning like pie, and that is strategic philanthropy or charitable giving. And there's one thing that we can do in these scenarios that a lot of people don't talk about. Maybe they don't know that they can do it, and you hit on it. And that is we can actually donate the private securities from generation one that wants to retire from the business to a charity or to a donor advised fund. And generation two can buy those shares back from the charity. And what that does is the charity, when they receive those securities, right, those shares, they don't pay capital gains tax on them when they cash them in. And then generation two can buy them back. You still have to be able to buy it, but that can help to alleviate a lot of the capital gains tax. And what that'll also do is for the family corporation, it's going to provide a CDA credit. So your accountant will be able to utilize that. And the capital dividend account or CDA credit allows you to tax-free flow some cash out of the business. So you can flow it out to generation two. They can use that to cover the cost of acquiring those shares. And you're also supporting charity at the same time.
Exactly. And that's a great strategy to implement, for anybody with, large investments, especially in their corporation, to be able to minimize tax while giving, philanthropically,
Yeah.
and benefiting your business long term by being able to have the additional benefit of that CDA account. And that's great to know, because it's something I didn't mention before. But for anybody with corporate life insurance or looking at getting corporate life insurance, you actually get a CDA credit for life insurance. So the CDA credit is your full death benefit minus the adjusted cost basis. Adjusted cost basis works a little bit differently in life insurance, but to make it easy, it goes up while you're funding the policy and it goes down over time.
Hmm.
So hopefully, if you bought the policy early enough, your adjusted cost basis is zero.
Yeah.
So if I have $2 million, I get a $2 million CDA. So when that corporate policy pays out to the corporation, I don't have to flow it out as a you know dividend. I can flow it out through the CDA account and a capital dividend and have all that money tax free. And that's the great thing about corporately owned life insurance is you can utilize it to flow money out for your corporation tax free. That can be used to pay for the capital gains liability. That could also be used to benefit your heirs.
Yeah.
And that's something that a lot of times is missed when we think about a succession plan and corporate planning. It's that how does the second generation actually benefit from this? Because you can put structures in place to be able to flow money out tax free. And that's going to be a huge benefit to anybody owning that corporation in the future because you
Yeah.
can then utilize that corporate money and retained earnings, flow it back out to yourself, and then be able to buy a new home. You'll be able to pay for your children's education,
Yeah.
and you didn't have to pay any tax on that money. So it's a real benefit when we do talk to the business owners, but also to the people that are actually going to be inheriting that business is how does this benefit them? The more life insurance and the larger the CDA, the more it's going to benefit them long term.
Yeah.
It's going to put more money, it's going to inject more money into the corporation, and it could inject more money into your hands personally to use for whatever you like. And had a huge benefit of not having to pay any taxation on that money.
Yeah.
I don't, it's a real win-win-win. You can pay for your capital gains. You can make sure you have a plan in place for your succession, and that person can also benefit if there's additional funds left in the policy to be able to have that personally and never pay any tax on it. So it's something that does come up a lot, and it's something that everybody should really know. It's hard to know everything.
Yeah, that's right.
But there's lots of strategies in place. And when you were talking about giving philanthropically, what we see a lot of high net worth individuals around Canada do as well is actually give life insurance
Yeah.
to two different organizations, like charities. Say a good example is the hospitals of BC. If we're going to think about Vancouver General, if it's something that it's close to your heart, and a lot of times it is for many people that have been had their lives affected. And for me, I was born in Peace Arch. A lot of people are going to be born in VGH, and you spent your entire life around these organizations, and you want to give back to them. We work with partners at Fraser Health, and what they can really utilize is large donations. So when they can utilize large donations, they can make large changes to their facilities, make sure that they're top of the line, making sure that everybody in the area has proper health coverage and all the tools to make sure that their physicians, doctors, nurses have all the tools available to help all the people in the area.
Yeah.
And what the benefit of that is that yes, you get to give to something that really impacts something close to your heart. But what it can also impact is a lot of people don't know this. You can actually take your estate liability and your taxation in your estate, which can be very large if you accumulate many assets.
Yep.
You can actually take that down to zero on your death.
That's right.
So by donating a life insurance policy, you can take that entire death benefit and actually have that as a charitable donation on your death. So you can say give $2 million to Vancouver General, you might have a $2 million estate need. That turns it into zero. There's no tip, no tax, nothing left for the CRA,
Yep.
and you've pre-funded all of it. So you can do that for a fraction of that $2 million in this example. And it's all taken care of. Charities benefit, the communities benefit, you benefit, and the only person it's taking away from is that additional money that would have been left for CRA.
Yeah, that's right. Yeah. A
So
lot of people don't realize that their year of death is their usually highest income earning year because you're deemed to have cashed out all your investments, all your property that you own, your business, and it's the rainmaking year, but just not
a,
for you.
exactly right. A lot of people don't think about, hey, if I die early, I have my RSPs. You know, if I'm not rolling that over to a spouse, that's all taxed. Your other non-reg, that's taxed. You know, if I have investment properties, that's taxed. You
Hmm.
know, and they're not going to let your assets go until you paid that money.
That's right.
So to have a plan in place, yeah, you could liquidate them. That's always an option. But if that money's going to the CRA, personally, I'd rather have it go to my heirs.
Yep.
And everybody can do that by having a charitable donation. They could do that through life insurance. They could plan ahead and not leave anything behind for the CRA to take.
Yeah.
That can all be left to who you'd like.
Yes.
And that can all be done at a lot less than most people will think. A lot of people will overestimate um, what that's going to cost them right now.
Yeah.
But if you're going to have a large estate liability, it's always going to be cheaper to fund it earlier
Yes.
than fund it later, right? Um, and it's just really, to boil down to it, it's doing better for you and your family and taken from the CRA, which, and you get the added benefit of giving to a cause that is important to you and can make a dramatic impact
Yeah.
for everybody around you.
Exactly. Yeah, that's a great point. I don't want to go too far into the topic, but the executor of the estate can also allocate funds to charitable donations in lieu of paying the CRA. And if you do it in a timely manner and it's very calculated, you can still wipe out estate taxes post passing of the person. And that's a different strategy. That's a different podcast.
Yeah, that is a different podcast. But one thing I do want to add to that, it's that if you have somebody as an executor on your estate, please let them know.
Yeah.
It's oh, over 90% of people don't know that they're the executor on
Yeah.
somebody's estate. And it's crucial because you may or may not have documents written. But if you really talk to somebody, if they're gonna execute your estate, really have them know what your hopes and desires and plans are so that they can help those come to fruition. Because most people don't know. It is not an easy process.
Yeah.
It's difficult because your executor is typically going to be someone very close to you. Um, I've done it. It's not a it's not a great time
Yeah.
to do. It's never a great time to have to do that.
Yeah.
So it's difficult. So please let them know, and please also talk to them about what you'd like, because all your assets are typically going to have tax unless they're rolled over. So what would you like to have happen with those assets? You're going to have your will, but something, if you have a direct conversation with your executor,
Yes.
it's always going to help them actually make a plan when that happens.
Yeah.
And you can see your hopes and dreams be done correctly.
Absolutely. The theme of all of that, even today's episode, man, is communication. We got to know what's going on. We got to know when you want it to happen, where it's going to happen, all of that kind of stuff. Yeah, for most Canadians, I think finding out you're named the executor, it's like the worst job that you've never applied for, and nobody wants to have that sprung on them.
100%. And it's, most people only do it once in their lifetime. And they don't make it easy.
Yeah,
no,
that's
no
right.
one makes it. No one makes it easy. It'll be a lot of first times for everything you're doing there, and uh, you want to make sure that when you're doing something like that, you're actually doing it in the way that that person would like. And the easiest way, like you said, is to communicate that plan and what you'd like to see happen when you're no longer there.
Yeah, yeah, exactly. Um, did I miss anything? Is there anything that you wanted to cover before we wrap up?
Oh, well, yeah. I would say like the big, as well as what we covered. The important thing is to think about your plan. And if you own a corporation, it's never too early to start planning because there's a lot of things in place that you can utilize to grow your corporation, to give back, to plan for your succession, or something we didn't really cover here today, but I'm sure you'll cover in other podcasts, is that if you want to grow your business as well, there's a lot of strategies that you can use and properly implement in your business that'll help you succeed long term. And having a financial advisor and to work with somebody to help you create that plan, create that roadmap is always going to be beneficial in your business because in reality, these things don't happen without a plan.
Yeah, that's right.
No one gets lucky, not everybody gets lucky and, doesn't know what's going on inside of their business. And it's really good to take that approach to all financial planning and everything that you'd like to see happen in your life. And that's not only with, succession planning or estate planning that can be growing your business, that can make sure you're properly protected, and that can be making sure all your loved ones are protected as well, and so that you have everything in order to make sure that no matter what happens, your business can continue to run successfully, your life can continue to run successfully, and that your family's success can be protected by implementing proper strategies, both corporately and personally.
Yeah, very well said. Very well said. Awesome. Greg, thank you very much for coming on. We really appreciate you, and I can't wait to have you back on for another topic.
Yeah, that's great. I'm really happy to join you here today, Tyson. Thanks for having me.
All right. Thank you.